And given 30 minutes, this is a topic that we can probably talk for 2 days, 48 hours, and might not finish. For a variety of reasons. As the esteemed panel was talking earlier, the regulatory process is not completely done yet. I don't think we're at a point where the dust has completely settled. There are many regulatory jurisdictions. There are certain products. If you look at interest rate swap, a subset of the currencies has, for example, been mandated to clear. There's a lot that's working on that end. CFTC, EMIR, some Asian regulators. There's a lot of rules that are being defined and continue to be defined. So it's hard to put everything in a very clear answer. What is the regulatory impact on things like margining and others? So what I wanted to do was to go over the process more of go under the hood a little bit on how at CCPs we are developing or reacting to the development of new margin methodologies, guarantee fund, and so on and so forth. So to give you a color, and I'll talk about a few asset classes, credit, interest rate swaps, because they are the most pertinent at this point in time. And sorry if I didn't introduce my background here. I've been at CME for close to 5 years now, and my job is the development of some of these risk models, pricing, margining, guarantee fund, liquidity add-on, things of that sort. So I'll use those things as we go along in the presentation. So before we go into some of the more technical aspects of things, I wanted to just put into a slide, what is risk management at a CCP? I mean, this says CME, but generally you would see the similar sort of items that all CCPs follow. There's a fair amount of policy work that we need to do around regulatory demands, stress testing, guarantee fund structuring, skin in the game, size of the capital structure. Those are very, very pertinent topics. Collateral program evaluation of what kind of collateral we expect is another risk management. Liquidity and concentration profile. As you can see, as CCPs, we have to also manage the amount of liquidity lines that we would need during times of crisis. There is interest rate swap. There are 18 or 19 currencies that we clear in a time of default. We'd have to be able to use some of those liquidity lines. The next aspect, which is now coming a lot more important from a new world standpoint, is default management. It's not just about sizing an initial amount or initial margin or a performance bond, different terminologies that people use. It's about actually preparing and really doing significant amount of mock drills and so on and so forth to make sure that if a crisis hit tomorrow, we are prepared. So if you look at CME, we clear a significant amount of the futures volume of the world now. We are a fairly large player on the OTC clearing side for interest rate swap. So now in a large default, there is a very good chance that we have to manage across different asset classes and products. So making sure that we are at the top of the game, and not just us, our clearing members, who at the time of default are going to be providing us with very key resources like traders and others, are really up to speed. So there is no latency. We're not searching for answers at that point. So it's very, very important. So this is one big aspect that has changed significantly in our trading as risk management. Risk modeling, which is just a lot more my area. I'll talk a little bit about the risk model, so you'll have enough content there. And the other pieces are market risk and credit risk monitoring. The monitoring of risks has undergone a significant amount of change, if not by number of what we monitor, but we have had to do a lot of technology adoption to expedite or speed up the amount of things that we can monitor. We are bringing in as OTC products like interest rate swaps have come into play, credit default swaps, and we are at the cusp of bringing swaptions for clearing to the market. Those things are it's going to be extremely important how we monitor those risks. Proactive risk management to be able to make sure that we don't have a London whale type situation fostered over several years. Those things are very important. That's why we have invested significant amount of work in technology and also in our market risk practices. Credit risk is another aspect. We call it the low rate level, low rate regime, or call it the concentration of players. There has definitely been a dwindling of number of FCMs or CMs in this space. So it's very, very important for us to have a clear view of. So in CME, for example, we have an internal credit monitoring mechanism. We definitely use the agencies as an input, but there is a fair amount of our own due diligence that we do to be able to make sure that all our counterparties are sound. Their affiliates that are clearing members or their parent broker-dealers or parent entities, they're sound at all levels. So this is generally a view of total risk management. Margining, which is the topic today that I'm going to talk is primarily one piece of it, but I wanted to talk about broadly what regulations have us focus a lot more. This is a slide that will give you a little bit more color on what are the different layers of protection. Maybe help with the question that was posed in the earlier panel of how CCPs are well collateralized. So if you look at CME, for example, we've got 3 different financial waterfall safeguards, as we call. We have one which clears the base, all our listed products, listed futures and options. We have one for interest rate swap, or rates, as we call it, and the other for credit, which is CDS. And across all of these, you will see that in the case of a default, there are several layers of protection. It starts off with the defaulting party's own performance bond. Performance bond is nothing for people who are not too familiar with CCP terminology. It's just another name for IA or initial market. So that is something that we have the first layer of protection. So it's important that we size very well, and I'll go through some of the sizing mechanics of that. The second thing is the defaulting clearing member guarantee fund. So a general rule of thumb for our IA calculations is about 99% or 99.5% type of a risk is something that we would put it into a IA calculation. But something which is extreme but plausible. For example, in today's market, a short-term move of 100 basis points or 150 basis points on the interest rate curve, those are things that we would try to mutualize it, because we believe it's a much more fairer way more efficient way of collateralizing or protect or making that risk be handled. So that's where the defaulting clearing member guarantee fund. Guarantee funds are typically computed or are basically assessed. You might have heard of the concept of cover 2. So when we face about 20 or 24 counterparties, we look at the potential shortfall of each of those clearing members, and we'll choose. We'll assume that 2 of the largest clearing members have simultaneously defaulted, and that kind of sizes up the guarantee fund. It's a concept very similar to insurance. So rather than paying for the extreme loss, you're trying to take those and mutualize it across your members. Then we have the blue box, which is the CCP's own contributed capital, which is fairly significant. And more important, size is definitely a very important thing, but more importantly, it's where in the structure it's put in. It's junior to the default. It's junior to the contribution of the non-defaulting players in the market. So as CME was very much instrumental in, not all CCPs, it's a general trend now, but most of the CCPs have migrated to this sort of a structure. CME was one of the first ones to propose a juniorized layer. It signals a lot. I mean, a lot of the default management or closeout is not just about sizing for IA or liquidation, but it's also about having the right incentives in the system for people who are either bringing risk or managing risk. So a large size of therefore it's very important that CCP's contribution are not too large so that it disincentivizes the non-defaulters to not be aggressive in different kinds of auctions, or it not be too small that it's exposing the non-defaulting guys. So there's always a balance. We feel that from a positioning standpoint, it is important for us to be junior. On the senior, there's nothing here, but written on this financial safeguard. But as CCPs, you would imagine if a loss is significant, it goes through the defaulted guarantee fund, non-defaulting guarantee fund, and also what we call assessment powers, which are unfunded liabilities at this point in time, but they are monies that we provide information to the clearing members that in case of a large default, you may have to put in X amount of more capital to us. So assuming all of those things defaulted, there are other avenues which are not listed here that as a CCP would take. But the point here is that if you look at across all financial structures, across all our safeguards, we have a very sound methodology of how we collateralize each amount and how we put the incentives into place. I'm going to switch gears a little bit and go somewhat more on the technical side of things. When we talk about margining, which is where the topic today is, I think the first question that we have to ask is, what is margin cover for? What are the different aspects of margin? So there are 3 or 4 different ways of looking at the margin level of collateralization. We'll take the default fund out. One is variation margin. Is basically an ex post bringing your book to par every day. It's taking debt out of the system. So that is one aspect of so as CCPs, we mark to market books every day for OTC and at least and 2 times a day for our listed product. So there is definitely taking the debt out of the system, bringing your portfolio, every portfolio to par. So at the end of the day, the CCP is flat from a market risk standpoint. That's one part of margining. Now, the other part of margining is initial margining. Initial margining has all the forward-looking or ex-ante components into it. We have to collateralize for the amount of time it will take for me to close out. And when it takes me X amount of time to close out, there are 2 things that I'll have to, at least 2 things that as a CCP I have to do. I have to make sure that I'm making the daily mark-to-market payments. And the second thing is that as we close out portfolios, we will be incurring costs of putting on the hedges and cost of liquidation or auction or cost of warehousing. So those are the 2 big elements that go into defining our margin calculations. Now there's a lot of literature and a lot of discussions these days on the margin period of risk. So as for OTC products, you will normally see in the cleared world that the margin period of risk is about 5 days with all the products that are cleared today. Interest rate swap, credit default swap, NDFs, OTCFX products. For futures, they generally are between 1 to 2 days. The European side of the regulation is more 2 days minimum. The US regulation is more 1 day for these. But what are the things that really factor into making that determination of 1, 2, or 5 days? I mean, why do these things? It's not a quantitative formula, but there's a lot of things that come into play into defining those things. In a product structure, as products are more standardized, we can probably hedge and liquidate them much sooner. So that goes into the determination, the turnover rates, the concentration, ability to manage the operational and other risks for the asset class is another view. So these are the default values that go into the initial margin or IA calculation. 1 to 2 days for futures, 5 days for OTC. Now the other things that I want to talk about is, once we know what the margin period of risk is, the IA, the initial margin methodology, is still something that we Just like we were talking about earlier in the panel, that there is a standardized method and then there is a internal method for uncleared margin. For the cleared world, we have been actually subject to margining methodology design and process for almost 4 to 5 years now, at least on the OTC side of things. And the regulators focus on, these are the 5 or 6 items that the regulators generally focus on the good properties that a margin model should have. Obviously, scalability is a very big key of how the margin methodology, because as clearinghouses, we don't control, we don't change margin models very frequently. So it's important for us to, for example, when we developed the initial margining model for US dollar swap, or the 4 currencies that are mandated, it was important for us to also look forward and say, how would this expand for 18 currencies, or how would it go to cross-currency or inflation or swaption? So there's a fair amount of that goes into the margining design. Obviously, coverage meets target levels. There's a lot of talk about 99%, 99.5% if you live in London, and 99% if you live in US. There is some regulators have defined, and they have defined it very differently. Like you should demonstrate 99% coverage over a 1-year look back or a 5-year look back. Some people have said that, some of the regulators have rather than defining coverage, they have said that you should sample at 99.5 or sample at 99. So it's more of a ex ante measure as opposed to coverage, which is more of an ex post measure. So, but we have to take that into account in terms of our model development. The third and the fourth are also very key topics which you might have heard about coming primarily from the EMIR side of the world. It's about procyclicality in margin model development. So there is a very strong. It's become quite prescriptive if you follow the EMIR requirements on how margin models should address margin ramp-ups and margin give-ups in pre and post crisis. So we have to develop our model. Ideally, margin models are somewhat more cyclical in nature, unlike guarantee fund, which is covering extreme but plausible scenarios, which is a lot more conservative. Margin models are expected. We don't want to be, for example, to closing out a 10-year interest rate swap book. People who are familiar with the interest rate swap world, it's probably not a good. It's too conservative to ask for 70 basis points in margin today, even though that might have been one of the 99% scenario if you look at 5-6 years, because the volatility at the point in time when those shocks happened were much higher. The world was in a different rate and vol regime. So margin models are generally built to adjust to, but there's always a fine line or a balance of how much pro-cyclical you want the margin models to be. So a significant amount of regulatory, I won't use the word prescription just yet, but oversight into how the margin models are reacting. So when we work with our either prudential or non-prudential regulators, the onus is these days that I see is to explain what if the volatility doubles over the next 10 days, how would your margin models react? Show me what was your margin models were for this kind of a risk profile 2 weeks before September 15th of 2008. How did it go up and down during that time? There's a significant amount of onus on us, and I'll show you a few graphs to give you an idea of what kind of questions that we deal with. Ease of implementation is also a very, very big deal for us right now, as most of the dealers here would probably know that, for example, for interest rate swap credit or even our listed product, we provide information end of the day or even during the day for people to replicate our margin methodology. There's a lot of pre-trade, post-trade, during the trade analytics that that firms have to do. They're deciding between sending an interest rate swap trade to LCH or CME, for example. They want to be able to replicate the margin methodologies because it has impact on capital. It has impact on their counterparty exposures. So we cannot develop a margin methodology in vacuum. We have to be able to ensure that we are developing something that can be given to our clearing members, and in many cases, even down to the firms, the clients. And we are working with quite a few vendors in this space these days to be able to deliver this piece. And transparency is another piece. Margining models generally are becoming quite transparent, even on the bilateral world as the unclear margin rules come into play. People will, the 99-10, look back. Those are the things that are going to be coming into. There will be a lot more transparency, but it's no longer just a. We have to make sure that we are providing enough information to our regulators, to our firms, and even in a public domain. How do we come up with some of these margin methodologies? Just to give you a classic, a more technical example, historical VAR is a very commonly pitched method for margining or IA calculations across banks and us. But it's very high level. You and I could do the historical VAR, 10-day historical VAR, and come up with completely different numbers. Your numbers could be 3 times mine, right? So there's a lot of other mechanics that come into play into how you are determining things like volatility scaling, volatility floor, correlation adjustment, blah, blah, blah. There's a lot of that stuff. So it's very important for us to be able to have the right level of transparency of our methodologies to the street so that they can replicate, understand, and kind of mitigate. A lot of questions I get today is from firms saying, hey, I have this portfolio. Could you tell me what the margin would be if the markets jumped up, gapped up X number of basis points, and the wall jumped up this much? Could you tell me what would be? So those are the things that are very, very important. The transparency is extremely, extremely demanding in the new regulatory world. I don't know how I'm doing in time, but I'll probably go over some of these. So this was the main slide in terms of regulatory. I want to go over a few more technical details. As I said, for historical VAR, for interest rate swap, we have these are some of the parameters that are chosen are not just our own risk appetite driven, but they're also driven by a lot of the regulatory landscape. For example, you can say, look at 5 years. It's something that is not prescribed on paper, but very strongly recommended to use a longer look back period that covers a full business cycle for your IA calculations. Stress VAR, another piece that's coming out as a incorporate not just last 5 or 6 years, but also ensure that there is. But today, if I just look at 5 years, even actually risk has gone off the radar. But for our IA calculations or IM calculations, we actually include them. Confidence interval 99.7, 99. Those things are very key. A lot of the models that you will see for interest rate, or in most of the OTC are even futures. There is this concept of PWMA that you hear across the street. Everybody uses it. Most people use it in some way or form. All this is doing is it basically allows us to inject a measure of volatility in my scenario generation. Margins are nothing but you take a portfolio, you subject it to X number of future scenarios that happen in the world, and you pick a certain, you get a loss distribution, you pick a certain number. But the art is really how are you defining those future world? Is it just 5-day shocks that occurred during the line June time period? You inject volatility based normalization into it. You inject correlation based normalization into it. How much correlation offset do you give across projects? Corn and ethanol. Are you comfortable giving full correlation? Are you comfortable giving X amount of correlation? Those are the things under the hood that will give us that gives us a measure of margin adequacy. Won't go over some of these. These are more internal. There's a significant amount of back testing onus on us, not just for ourselves. This is something that we at CME have been doing for ages, but this is coming out a little bit more in the front because regulators today are quite interested. We provide, before coming up with a new model, we are providing them with thousands and thousands of risk profiles. Again, at CCPs, we don't filter out people from leading portfolios. clear products, but we don't say that you can only do it for clients or you can only do spreads, we will not allow you this. We have to ensure that our models are going to work for any portfolio, any risk profile at any point in time. So we have to that somewhat that blind nature of requirement that process manifests itself in the excess amount of backtesting that we have to be and give it to the regulators. This is just a slide talking about an example of backtesting. We're showing the portfolio, how the IA model reacts over different time periods. I think I'm going to pretty much stop it there. I think the only other item I want to talk about, which is a big focus right now, especially given the collateral squeeze or the collateral demands, is the need for portfolio margining. As you can see, as you might have heard, there's a lot of talk about putting together or margining together, not just across products, but even across, in some instances, across clearing houses as well. Futures and cash, for example, is a potential. Or in the case of CME, specifically, Euro-dollar futures and OTC swaps, because they have two different financial safeguards, but they don't have to necessarily be. They are very nicely correlated products. In times of default, those correlations definitely don't break down. So for items where portfolio margining is deemable to be done, we have to make sure that our margin models are able to do that. And our mathematics are able to cover those things. I'm going to stop here. I'm sure I didn't cover 80% of what I wanted to cover, but in 30 minutes, just give you hopefully I gave you a snapshot of what IA and business margin and you go to this.
Can you still run through what happened with yields and what you saw?
I think these were. I think we were generally. I think the amount of IA, our initial margin that we had, and I don't have exact numbers, but we were. I think none of those breached for any of those portfolios. I think we had about several thousand. We didn't breach more than 50%. I remember a few small portfolios that came to about 40%, which is very much in line. If you look at a 5-day margin, should be about 2.2 times theoretically about what a 1-day large movement. So we were extremely well covered from our margin, and you would expect that. The scenario, something a breach, you would expect something like a U type thing to happen. We did have, I believe, that some of the margin models would have that around QE2 when 2010. There were 50 basis points more than that. But I think, again, we strive for 99% coverage, so there is going to be 2 to 3 breaches. It's very easy to come up with a very high margin model that will kill the problem.
Hi, in terms of liquidity, I'm not sure if your initial margin calculation involves some sort of expected liquidity cost and 9% mark or without, right? Something like that.
Oh yeah, it does, quite a bit. It does. In fact, I didn't get a time to cover that, but margining models are generally historical time series driven, like they are stretch periods. But for liquidation add-on, we have a process for most of the products now, especially on the OTC side. We poll the markets, so we will poll the liquidity providers for give us the cost for closing out this amount of books of different sizes. Because generally, initial margin models you would expect them to be linear in nature, but the liquidation costs are not. They're super linear because they tend to act with 3%. So what we do is we get those what we call core results, and then we project them onto the portfolio. There is a significant amount of there could be there is liquidation add-on for most people. So in the case of interest rate swap, for example, because to be clear, up until 300 million in IM, we don't charge in liquidation. Because it's base IM calculation is enough to cover non-market and without costs. But anything beyond 300 million, we have a liquidity.
My apologies, but I'll ask one more question if you don't mind. It's got to do with the mechanics of default fund or what have you. So in an unlikely event, if a clearing member does default, CCP model remains largely untested. Now you end up building a portfolio of interest rate swaps, NDS, research options, and what have you, CDSs. Do you have a team of traders who liquidate all that, or would you have contributed traders from the street?
Good question. I think I'll answer the first question. Is that I would say that I would definitely not say that the margin models or models are not tested, because one of the things that we have to do is we have to show resilience of our models through extreme rate, vol, correlation. So there's definitely that test. But the second part is very, very valid. Who is coming in? So we have what is called a default management committee. Active, we call it an active default management committee as well, where we will, clearing members are obligated to provide traders who are going to come in upon us declaring a default, and several activities that they will perform. They will initially come in and hedge the portfolios. There's a lot of activities, things that we could do ourselves before the actual traders show up. Things like, in case of interest rate swap, we have access to the treasury and Euro-dollar market ourselves. Our goal is that we can neutralize. In fact, a lot of the default drills that we perform today, even when the traders come in, a lot of the macro hedges are using the treasury position and put into invoice to get this basis. So there's a fair amount of that we do, and we do get in. There's a very formal agreement for active to send traders to the market. There's a whole rules to ensure that the secondment process is not compromised. People will be, the clearing members could be penalized for not performing. So there's a lot of checks and balances built in on top of mathematics to ensure that you're able to close out positions.
Right. So just building on that point, you mentioned earlier on about valuation models and uncertainty around those, which I interpret as some measure of model risk. On the dealer side, typically you will have a process like a P&L attribution, where you're composing your P&L as a way to test the efficacy of your models. I'm curious as to how CCPs sort of do that. So similarly, what sort of processes do you have to manage valuation model risk?
No, actually, excellent question. In fact, we do have a very robust process of attribution ourselves, which is a lot of that falls in the how we do market risk monitoring. I'll give you some examples. So if I have a portfolio that I'm clearing that has more dollars than you are, or G4 risk in it. So we do know, we don't only look at the margin at a US dollar equivalent level, we look at the exposures from that portfolio to the out of model conditions at each individual currency. So we're looking at the exposures at currency level. We look at portfolio for option types of positions for portfolio. We have things like we'll monitor expiry risks. So we will say that over, as things get closer to, as portfolios have shorter dated positions, we look at stress conditions where what if some of those trades expire against us, and what would be the level of collateralization that would be needed. So there's a lot of real-time monitoring that is happening beyond the model itself to ensure that we have a handle on which portfolios could potentially be compliant. There's a very strong limits process that we follow top day, which is we do not allow firms or clients to, or we have limits that we impose on the firms impose on the clients to make sure that no more of X amount of risk is going to be cleared on that given day. Again, we take quite a few times, we take a lot of preemptive measures. We will ask if we think that there are some portfolios or some clients have become extremely large relative to their credit health. We may ask them to put more collateral, put risk-reducing positions, or close out certain so that's part of our day-to-day risk management. I probably covered the tip of the iceberg here in terms of what we do, but hopefully gives you a measure of things that we haven't done.
What is the typical number of counterparties that you're monitoring?
Again, if you look at, we have about, in the case of interest rate swaps, to give you an example, we have about 25 clearing members, house origin, customer origin. For OTC, and even for listed now, we have what is called an LSOP regime, which means we have actually monitored for each and every portfolio down to the level. So if if I am actually dealing with as asset manager, for that asset manager has 10,000 accounts, so we will actually be margining 10,000 accounts. We call money on a net basis, but we do the IA calculation literally down to the portfolio. That is actually a big technological challenge for us. So we have actually been beefing up quite a bit on our technology investment to make sure that we can do all of that stuff in 10-15 minutes that we have in the day.
Seems like you have a lot of buffers, high confidence interval, the default fund. Has there been a study on the cost to market of the clearing model versus the non-clearing model? And then in terms of operational risk, I heard one of the panelists before mention about trade compression. Are you doing so at the CME?
Yes.
And then my last comment is I thought you said something about pro-cyclical. That could be a bad thing when volts go down. How do you account for that?
You have three questions. I'll take the second question first, which is compression. Yes, we do offer compression services. We have a lot of people, L Markets, Optima, LCH, everybody is offering compression. There are various forms of compression solutions that we offer. One is obviously a riskless compression, very good for capital charges. But as I believe Milton was talking about the need for risk compression, which is dealer-to-dealer stuff that we have actually started, and we encourage a lot of compression based on people's own exposure. So, naturally, yes, wanted to take out risk, but counterparty was another dealer. They would generally be flat. It is more beneficial for them to do that attribution and reduce their risk. Overall, on the client side, doesn't change. Those are a lot of other compression solutions that we're working on. Pro-cyclicality. Pro-cyclicality had always been part of our model. We've always had things like volatility floor, correlation floors, in the sense that we don't offer correlation unless we think that we just don't go on historical time series. So there was an element. Now, what has happened in the last year or so is that, especially coming out of the EMIR world, is that it has become fairly prescriptive. So we are adjusting our methodologies to be able to ensure that we're meeting some of those regulations. But procyclicality has always been, it's a trade-off. You don't want your margins, as I said, to be 100 basis points today if you're not in December 2008. But at the same time, you don't want your initial margin on a 10-year interest rate swap to be 10 basis points. It's got to find the right balance. We have concepts of wall flow and other, which means our forget your first one.
The cost of doing business before clearing and post clearing, in all the layers you have that you mentioned before.
I think that's working progress. I'm not, I would say, an expert. There's a cost to each of those. If you look at the margin, CFTC has a capital cost. If you look at guaranteed fund and assessment, Basel has its cost. There's a lot of costs at different layers. For clear versus unclear, I think the debate is playing out in the market. I would say premature at this point in time to give a number. Thank you.